Okay, so we are still on ISO of income taxes, right? In the previous video, we solved one example on determination of current tax, right? In this video, I'm going to continue and look at what we call deferred tax. Deferred tax. Don't forget, we've looked at the first component, right? Which is the over and under provision. We looked at the second component, which is the current tax. And then now we are on the final component, which is the deferred tax. And then we also look at the movement in deferred tax, which is the increase or decrease in deferred taxation, right? So let's proceed. What is deferred tax? This is the name, deferred tax, right? So deferred tax is the estimated future tax consequences of a transaction and event recognized in the financial statement of the current and previous years. So you are estimating the future tax consequence of a transaction that has been recorded today or in the previous what period, right? And then it says deferred taxation is a basis for allocating tax charge to particular accounting periods. The key to deferred taxation lies in the two quite different concepts of profit. Now, we said deferred tax, okay, is the estimated future tax consequence, the estimated future tax consequence of a transaction and event, right? Recognized in the financial statement of the current and previous what periods. So we are looking at the future tax consequence of what we are doing today, of the transaction that we are recording today. What is its future tax consequence? That's what we mean by deferred tax. Not now, but deferred to the future. What is the tax consequence of whatever you are doing today? And that is mainly, or deferred tax mainly happens as a result of the differences between the amounts recognized by accountants in their books and then amounts recognized by tax authorities for the same item, right? So if for one item, accountants are attributing or recording a different figure and tax authorities are also recording a different figure, then there's likely to be a deferred tax, right? Now, it says deferred tax is caused by two main things: accounting profit, which is the figure of profit before tax reported to the shareholders in the published account, and we have what taxable profit, which is the figure of profit on which taxation authorities base their calculations. Okay, so we are saying that deferred tax arises from two things: the difference in accounting profit and taxable profit. We've in the previous video we looked at accounting profit. We took the accounting profit, we adjust the accounting profit to get the taxable profit. So the accounting profit is like the profit that the accountants record in their books, right? And then they report to their shareholders in the published account. The figures the accountant record in their books is the accounting profit. The taxable profit is the profit that the tax authorities, okay, use to charge your tax or use to assess your tax liability, right? So we said with a taxable profit, it is the figure, okay, that tax authorities use, the profit that tax authorities use to determine your tax or liability, right? And normally we get a taxable profit by picking the accounting profits and then adjusting it, adding back um, deductions that are not allowed, and then lessen income that is not taxable. Now, before we start, let me bring you to, or let me explain something to you before we move on. Right now, when you pick assets, okay, for accountants, we have something we call the carrying value. And you know how we get carrying value? We compare or we less accumulated depreciation and accumulated impairment losses from an asset or from the cost. So with carrying value, it is cost minus accumulated depreciation and accumulated what? Impairment losses. That's how we get the carrying value. The tax authorities, they don't have carrying value, they don't use carrying value, they use what we call the tax base, the TB, right? So tax authorities, they use what we call the tax base, the TB. It's the same thing. The tax base is the cost minus capital allowance. Cost minus capital allowance. Don't forget, tax base is what? Cost minus capital what? Allowance. So C minus CA, whilst the carrying value here is the cost minus accumulated depreciation and accumulated impairment what? Losses, right? So I'm saying accountants, we do, or we look at the carrying value. Tax authorities, they look at what the tax base. It's the same thing. Carrying value is the cost of the asset minus accumulated depreciation and accumulated impairment losses. Tax base is the cost minus what? Capital allowance. Basically the same. So we compare the carrying value with the tax base for assets. If the carrying value is bigger than the tax base, if the carrying value is bigger than the tax base, we have something we call temporary temporary difference. Temporary difference. So the difference between the carrying value and the tax base is a temporary difference. The difference. Okay. The difference between the carrying value of the asset and the tax base is called a temporary difference. If the carrying value is greater than the tax base, the carrying value is bigger than the tax base, we have what we call the taxable temporary difference. We have the taxable, okay. So let me write the taxable temporary what difference? TTD. Taxable temporary difference. If the current value is bigger than the tax base, we have what we call the taxable temporary difference. On the other hand, where the current value, right, is less than the tax base, is less than the tax base, or the tax base is greater than the carrying value, then we have something called the deductible temporary difference. Deductible temporary what? Difference. So once again, I'm saying that if the carrying value is bigger than the tax base for assets, we have what we call taxable temporary difference. And if the tax base is bigger than the carrying value, we have the deductible temporary difference, right? The difference between the carrying value and the tax base is just called the temporary difference. Temporary difference is the difference between the carrying value of an asset and the tax base. For liabilities, the other way around. For liabilities is the other way around. So be very careful. For liabilities, if the carrying value is bigger than the tax base, we have a deductible temporary difference. If the carrying value is bigger than the tax base, we have a deductible temporary difference. And if the tax base is greater than the carrying value, we have a taxable temporary difference. So watch out the two for assets and liabilities. Now back to the assets. Why do we have a taxable temporary difference if the carrying value is bigger than the tax base for assets? Now what it means is that if your carrying value is bigger than the tax base, what it means is that the tax authorities will be giving you lesser capital allowance, right? Because the tax base is lower. So capital allowance, their capital allowance, or their depreciation in quotes for the tax authorities, their capital allowance will be less. If they are giving you less capital allowance, what it means is that you'll be paying higher profit. That's what it means. Because we said we need to adjust accounting profit to get taxable profit. And with less capital allowance, we add back depreciation and with less capital allowance. So if you are lessing a smaller figure, if the tax base is greater, if the carrying value is bigger, we said if the carrying value is what? Bigger than the tax base. If the carrying value is bigger than the tax base, it means that the tax base is smaller. So GRA will have a smaller capital allowance for you. And when they deduct capital allowance, right, it means that your taxable profit will increase. So that's the reason why that's the reason for we saying that when the carrying value is bigger than the tax base, it leads to a taxable temporary difference, right? On the other hand, is the other way around. If your carrying value is smaller than the tax base, if your carrying value is smaller than the tax base, or the tax base is bigger than the carrying value, now it means that the capital allowance granted to you is likely to be bigger than what? The depreciation. So when GR is computing your taxable profit, they will deduct, okay, a bigger capital allowance, which will reduce your taxable profit. And that leads to a deferred tax what? Asset, or a deductible temporary difference. Now, we'll get back to this. Let's continue. So, we've looked at what the temporary difference is. We say, is there the difference between the carrying value of the asset and the tax base? And the tax base, carrying value and the tax base, right? What is tax base? Tax base is like the same as the carrying value in quotes, but it's like that's the amount attributable to an asset for tax purposes, right? So tax base is the amount attributable to an asset by the tax authorities for tax purposes. Okay, So the amount at which they are holding the assets in their books for tax purposes, that's the tax base. We know carrying value already. So tax base is the amount attributed to an asset or liability for their tax purposes. Okay. Then we have examples of temporary differences. And we said temporary difference. I'll explain this thing again, but we said temporary difference is the difference between the carrying value of an asset and the tax base. Okay. So it says certain types of income and expenditure are taxed on cash basis rather than accrual. And then the difference between a non-current assets depreciation charge and tax allowance. That's their tax depreciation. Tax depreciation is similar to capital allowance. This is the most common practical example of temporary difference. So we are looking at what creates temporary difference. What creates temporary difference? It's the difference between what? One is the difference between depreciation and what? Capital allowance. That's what creates temporary difference. Because if an entity buys an asset at what? 100,000. Okay. If depreciation is 20 and capital allowance is what? 30. Okay. With the same asset, are you following? The entity and GRE, the tax authority, they will have different carrying values. So we said the asset cost what? 100,000. But depreciation is 20,000. Capital allowance is 30. So you see that the carrying value here was 80. Okay. But the tax base was 70. So can you see that depreciation and capital allowance, the difference between the two creates temporary difference. So here we have a temporary difference of what? 10,000. That's the 80,000 minus what? The 70,000. So the difference between carrying value and the tax base, we said the temporary difference. And we are looking at things that create the temporary difference. We said one is what? The difference in depreciation and capital or tax allowance. Okay. When they are different, when depreciation is different from capital allowance, then we are going to have temporary difference. If they are the same, there will be no temporary difference. For example, depreciation is 20,000, capital allowance is 20,000. In that case, the carrying value and the tax base will be what? 80,000. So there will be no temporary what? Difference, right? So one cause of temporary difference is the difference between the carrying value of the difference between the depreciation charge and the capital allowance or the tax depreciation, right? And it says, and that difference is what? Income and expenses here, which are taxed on cash rather than accrual. Okay. I'll look at all these things in example. Let's come back to the main thing: taxable temporary difference and deductible temporary differences. Taxable and deductible temporary differences, right? Now, if you remember what I just told you, we said that I told you if the carrying value of an asset is bigger than the tax base, carrying value is greater than what? The tax base, then we have what we call taxable temporary difference. And I'll explain the reason why it's taxable. Because it will create a higher taxable profit in the future for you. When the carrying value is bigger than the tax base, it means, or the tax base is smaller than the carrying value, it means that your capital allowance claimed will be small. And when we are less than a small capital allowance, that will increase your taxable profit. So it creates a deferred tax liability or a taxable temporary difference. So when the carrying value is bigger than the tax base, we have what we call taxable temporary what? Difference. Taxable temporary difference. And it will create a deferred tax liability. Don't forget, if the carrying value of an asset is bigger than the tax base, it creates what we call a taxable temporary difference, which will turn into a deferred tax what? Liability. But when the carrying value is less than the tax base, or the tax base is greater than the carrying value, then it creates what we call the deductible temporary difference. Deductible temporary difference, which will create a deferred tax asset. So we have to know this. This for assets. Liability is the other way around. Okay, good. So this is taxable temporary difference, which are temporary differences that will result in taxable amounts in determining taxable profit in the future, right? When the carrying amount of an asset or liability is recovered or settled, right? So we said the taxable temporary difference will create taxable amount in the future, meaning to create a deferred tax liability. And since the taxable temporary difference arises when the carrying value of an asset is greater than the tax base, I've talked about this already. Then we have, it says taxable difference creates deferred tax liability. I've talked about that, right? If we have a taxable temporary difference, then to create a deferred tax liability. Let's continue. Let's look at the deductible temporary difference. So with the deductible temporary difference, we said if the tax base is rather bigger than the carrying value, or the carrying value is less than the tax base of an asset, then it creates what we call a deductible temporary difference, right? And this will create a deferred tax asset. So it says deductible temporary differences, which are temporary differences, right? That will result in amounts that are deductible in determining taxable profit, right, of future periods when the carrying amount of the asset or liabilities recovered or settled. Deductible temporary differences arises when the tax base of an asset exceeds the carrying value. So we said when the tax base, okay, is bigger than the carrying value, then we have what we call a deductible temporary difference, and this will create a deferred tax asset. Deferred tax asset, right? So we say deferred tax asset is the amount of income taxes recoverable in future periods in respect of, can you see taxable and can you see deductible temporary differences? So it says deferred tax asset is the amount of income tax recovered or recoverable in the future as a result of what? Deductible temporary differences. So we said deductible temporary differences will create a deferred tax asset. Deductible temporary differences will create a deferred tax asset, right? Then we have carry forward of unused tax losses. This one is will be done will be looked at by maybe ICAG students, right? Students that are writing the ICAG in either financial reporting or corporate reporting. But in this video, we are not going to cover it. We are not going to cover unused tax losses. We'll do it in our main ICG tuition session. Okay. Then we have the carry forward of unused tax credit. So all these things create deferred tax asset, but the most common is the first one. Okay, deductible temporary differences, and that's what we are going to be looking at throughout the lesson, right? So that's it with temporary differences. So we looked at the definition of a deferred tax, okay, and we said that when the carrying value of an asset is greater than the tax base, carrying value is greater than the tax base, we have a deferred tax. It gives a deferred tax liability. When the carrying value is bigger than the tax base, we have what we call a taxable temporary difference, which creates a deferred tax liability. That's for assets. And then when the tax base is rather greater than the carrying value of an asset or for assets, then it creates a deductible temporary difference, which in turn creates a deferred tax asset, right? Then we looked at um the definition of deductible temporary differences and then the taxable temporary differences. Okay, so we have deferred tax liability here, amount of income tax payable in future in respect of temporary differences and in respect of temporary timing what differences. Yes, so let's to summarize everything. Okay, let's summarize everything. We said for deferred tax asset, okay, or for deferred tax, as it implies deferred tax, it says that we look at is the estimated future consequence of a transaction or event that has happened today or in the previous period. We estimate, we look at the future tax what consequence, and we look at the two main things that can cause the deferred tax. We said differences in the accounting profit and then taxable profit. Then we look at temporary difference. We said when you pick the carrying value of an asset and the tax base, the difference between the carrying value of an asset and the tax base is what we call the temporary what difference. The difference between the carrying value of an asset or liability and the tax base is what we call the temporary difference. And we said for assets, if the carrying value is bigger than the tax base, we have a taxable temporary difference, which will create a deferred tax liability. For liabilities is the other way around. For liabilities, if the carrying value is bigger than the tax base, then we are going to have a deductible temporary difference, which will create a deferred tax asset, right? So we looked at all these things already. We look at the tax base. We said the carrying value and the tax base, they are virtually the same. The only difference is that with the carrying value, it is the cost minus accumulated depreciation, accumulated impairment losses. The tax base, it is the cost of the asset minus capital allowance. That's all, right? So tax base is the amount attributable or attributed to what an item by tax authorities for tax purposes. Okay. Then we look at examples of temporary differences. Here, what can create temporary difference? And we said the most common cause of temporary difference is differences in depreciation and capital allowance. If depreciation is not the same as capital allowance, then it will create a temporary difference because the carrying value and the tax base will differ, and it will create a temporary what difference. Okay, so that's it. The temporary differences, we have two. We have the taxable temporary differences and the deductible temporary differences. Then let's look at this, and then we see what we can do. It says reasons for recognizing deferred tax. Reasons for recognizing deferred taxes. So if we say deferred taxes is the estimated future consequence of the estimated future tax consequence of a transaction that has happened there today or in the previous period, why are we then recording it now? Right. So this is one reason, because of the accrual concept. So this accrual concept requires its recognition. The deferred tax is a liability or asset which will eventually be settled, which will eventually be settled. So these are the two main reasons for recording a deferred tax, either asset or liability. That's the reason for recording deferred tax. It can be asked in exams, the rationale behind recognizing deferred taxation, right? The first reason is because of the accrual concept. And second, we said the deferred tax asset or the liability will eventually be what? Settled, right? So let's look at the accounting entries for deferred tax. I think we've done this already, but let's go over it again. Let's go over it again. So with this one, we said that we compare the carrying value of the assets. If it's an asset, compare the carrying value with what? The tax base. Okay. And the difference is the temporary difference. So temporary difference is the difference between the carrying value of an asset and the tax base. We said for assets, if the carrying value is bigger than the tax base, we are going to have a taxable temporary difference. Okay, which will create a deferred tax liability. If the tax base of an asset is bigger than the carrying value, then that will give us a deductible temporary difference, which will in turn create a deferred tax asset. So when you get the temporary difference, then you apply the tax rate on it. You have your deferred tax. So let's say we've gotten the carrying value of an asset. Okay, so let's say an asset cost 100,000. Okay, the cost of an asset is 100,000. So 100,000. Depreciation is 20,000. So let's put depreciation 20,000 here. Okay. Capital allowance is 30,000. So we have the capital allowance to be 30,000. When you deduct here, you are going to have 80,000 as the carrying value, and the tax base is what? 70,000. So here, what do you see? We have the carrying value to be 80, temporary tax base. Carrying value 80,000, tax base 70,000. So we could say that the carrying value of the asset is bigger than the tax base. So we have a taxable temporary difference. Taxable temporary difference of how much? 10,000. What you do is you apply the tax rate on the 10,000. So let's say tax rate is 20%. If tax rate is 20%, okay, then your deferred tax liability will be 20% of the on the temporary difference. So you apply the 20% on the temporary difference, which is, so 20% of 10, which is 2. So 2,000 is the deferred tax liability, because this is the temporary difference was a taxable temporary difference. It was a taxable temporary difference. So it gave us a deferred tax liability of 2 million. Now, if you go back to the beginning, we said the amount that we record in the P&L has three main things: over and under provision, current tax, and movement in deferred tax. The deferred tax is only the movement that we record. Mind you, it's not the whole deferred tax that we record. So when you have opening deferred tax, you have to compare with the closing. So this 2 million that this 2,000 here that we computed, it's the closing deferred tax. It's a deferred tax. But we have to record the movement. So if there's opening, go and compare. So let's say we have opening deferred tax. Okay, opening deferred tax liability of, let's say, of 1.5, of 1.5. Okay, if the opening deferred tax is 1.5 and the deferred tax that we've computed at the closing is 2, you realize that the deferred tax liability has gone up. Okay, and if deferred tax liability has gone up, it's an expense. So let me give you this explanation and you take it. If you compute your deferred tax liability and you compare with the opening, and deferred tax liability has gone up, if liability has gone up, it's an expense. So you have to add it to your current tax. It will increase your current income tax expense, right? So if you compute your closing deferred tax liability, compare with the opening. If there's an increase in deferred tax liability, as we have here, the opening is 1.5, closing is 2, so there's an increase of 1.5. That increase should be added because increase in liabilities and expense, so we have to go and add it when we are computing our income tax expense. On the other hand, if it has reduced, if opening is, let's say, opening deferred tax liability is like 3, okay, and closing is 2, you realize that the deferred tax liability has gone down. Opening is 3, closing is 2, so deferred tax liability has gone down. If liability has gone down, it's an income, so that amount should be used to reduce the income tax expense. So if if deferred tax liability has gone down, we less. If deferred tax liability has gone down, we do what? We less. If deferred tax liability has gone up, we add, because it will increase our tax expense. So that's what we have here. Okay, so that's the explanation that we have here. It says when you have increase in deferred tax liability, okay, that's what all we have here. It says if the deferred tax liability has increased, it is saying we should debit income tax expense, right? So it says here, right? So be very careful. It is the movement on deferred tax that will be accounted for. It's the movement. Okay, good. So it says you debit if deferred tax liability has gone up, increase in deferred tax liability. Say we should debit income tax expense, and then we'll credit deferred tax in the statement of financial position. So that's what I said. If liability has gone up, if liability has gone up, we add. Okay, so we debit the income tax expense to go and add. They will take the closing as a liability, non-current liability in the financial position. Reduction in deferred tax liability. If deferred tax liability has gone down, I told it's an income. So can you see we are crediting P&L or OCI, and we will debit same financial position. So what they are saying is that here, if you are back here, it says if there's an increase in deferred tax liability, we should debit income tax expense or OCI. There's OCI here because of revaluation, right? So we'll look at the impact we'll look at the impact of revaluation on deferred tax asset and liability and how to treat it, right? So that's the reason why they brought the OCI here, right? So that's it. With assets is the opposite. If you're opening deferred tax asset, okay, your opening deferred tax asset is, let's say, 2 million, and then your closing deferred tax asset, your closing deferred tax asset is 4 million. Can you see asset has increased? If asset has increased, it's an income, so you have to go and less from your income tax expense. We have to go and what? Less from the income tax what? Expense. If asset goes up, it's an increase, it's an income. It's an income, so you have to go and less. So with this one, you have to rather what? You credit P&L. Okay, you credit P&L with the difference, and then you debit your asset because asset has gone up, it's an income. If asset has reduced, if your deferred tax asset has reduced, take note. If your asset has reduced, an expense. Your opening, let's say your opening deferred tax asset is 10, and your closing deferred tax asset is like 4. Can you see that the asset has reduced by 6? Your opening was 10, closing 4. Your asset has gone down by 6. So that's 6. If asset reduces an expense, we have to go and add it to the income tax expense. So in that case, we will debit P&L or OCI and we'll credit the deferred tax asset. So if the deferred tax asset has gone down, if it has gone down, and we have a deferred tax, if the deferred tax asset has gone down, has reduced, it's an expense. So we have to add it to the income tax expense by debiting the income tax expense, right? So that's it. Let's look at this question here and then we will pause. We're almost done with IAS 12, income taxes. So let's look at this question. Right. So it says the Excellent Bank PLC, the Excellent Bank PLC bought computers at a cost of 100,000 cedis. The equipment are depreciated using the normal accounting rules and has a net book value of 40,000. For tax purposes, the capital allowances of 30,000 cedis has been allowed. And then the requirement is, we says we should calculate, it says we should calculate the tax base of the equipment and compare with the current value to determine the deferred tax, assuming a tax rate of 25%, post the transaction into the appropriate accounting journals. So we are looking at the debit and the credit, right? So here we said we have to compare the current value with the tax base. What's the current value of the asset? Here the current value is what? The current value is 40,000, right? We've been given the current value. Okay, that's the net book value. Then the tax base, the TB, what's the tax base of this asset? So the tax base will be the cost minus capital allowance. Okay, the current value will be the cost minus what? Depreciation. Current value will be cost minus depreciation. Tax base will be what? The cost minus capital allowance. By this question, we've been given the current value already without depreciation. So the depreciation was deducted from the cost and we got a net book value of 40,000 or the current value of 40,000. Tax base will be the 100,000. Okay. Tax base will be cost 100,000 minus capital allowance. What's the capital allowance? 30,000. Okay. So that's it. So we are going to have how much? 70,000. Okay. So here we have current value to be 40,000. So CV to be 40,000 and then the TB, the tax base to be equal to what? 70,000. So you realize that here, okay, the current value is lesser than the tax base and it's an asset. So what do we have? We are going to have what we call a deductible temporary difference. Are you following? We have a deductible temporary what? Difference. This is not taxable. It's an asset. The current value is less than the tax base. Current value is less than the tax base, or the tax base is bigger than the current value. So here we are going to have what we call what? A deductible temporary difference, not taxable. It's a deductible temporary difference, which will give us a deferred tax what? Asset. So deductible temporary difference of how much? 30,000, right? That's the difference between the 40,000 and the 30,000. So here we have a deductible temporary difference. Why is it deductible? Because the current value is less than the tax base, or the tax base is tax base is greater than the current value. So the current value is less than the tax base, so it is deductible. So what will be our deferred tax asset? Okay, what will be our deferred tax asset? We said that would be the tax rate on the temporary difference. So 25%. Okay, 25% on the temporary difference. So 25% times, so the 25% by the 30,000. Okay, and that will give us 25% of 30,000, give us 7,500. So 7,500 is the deferred tax asset. So because this is a deferred tax asset, see, it's an asset too. It's an asset, right? And let's assume we don't have opening. Let's say there's no opening deferred tax asset. Okay. So here, because it's an asset and we don't have any opening, it's like the whole 7,500 is the increase in deferred tax asset. And we said if it's an asset, if asset increases, we have to go and credit the P&L, we have to go and less. Okay. So we will credit the P&L and we'll debit the deferred tax asset. So that with the journal entries, we were going to debit your deferred tax asset, which will be your asset in a financial position. Okay, a non-current asset of 7,500, and then you credit your P&L. Okay, so you credit P&L or income tax expense. So please write it anyhow. You credit your P or L. You credit your P or L. Okay, or you credit income tax expense. I think income tax expense will be more appropriate because that should be used to reduce the income tax expense. It will be something complicated or yeah, challenging question. Okay, so this is it. This is how we do it. It's very, very simple. Just get your carrying value, compare with your tax base. You know how we get the carrying value and the tax base. Carrying value is the cost minus accumulated depreciation and accumulated impairment losses. Tax base is the cost minus capital allowance. Compare the two, determine whether it's taxable or what deductible. So if the carrying value is bigger than the tax base of an asset, it is taxable. On the other hand, if the carrying value is less than the tax base of an asset, it is what? Deductible. And the deductible will create a deferred tax asset, and the taxable will create a deferred tax what? Liability. So as simple as that, right? Okay, so that is it with this question, right? We have other areas which we'll be looking at. We have other areas. We have other areas, right? So let me explain these other areas and then we will close. Okay. Let's look at other areas. So with the other areas, we have other areas or specific areas. We have revaluation. Revaluation has impact on deferred tax assets, right? Then we have share option schemes and use tax losses, business combinations and deferred tax, provisions for realized profit and unremitted earning. Now here we are going to look at only one. We look at only this one here. This one's share options and use tax losses, business combination stuff. The advanced concepts in corporate reporting, right? So we will look at this in the ICJ class, those that are writing the ICJ exams. For them, we'll look at this, we'll look at all of them in class with them, right? So in this video, we only look at the revaluations and then that'll be it, right? So what you have to know is that when there's revaluation, if there's revaluation upward, now if you have an asset and you revalue it upward, do you realize that the carrying value increases? And the more the carrying value increases, what do we say? The more, if the carrying value for an asset should increase more than the tax base, we are creating deferred tax what? Liability. So when there's revaluation upwards, when there's revaluation upward, it creates an additional deferred tax what? Liability. Are you following? Valuation upward creates additional deferred tax what? Liability. So if there's a revaluation, then it will result in what we call a deferred tax liability if there's valuation upward. On the other hand, a revaluation downwards, if there's a downward valuation, then it's likely to create a deferred tax asset. Because if you revalue your asset downward, you are reducing the carrying value. And so it's likely that the tax base will be bigger than the what carrying value. And that will create or that might create a deferred tax what asset. So revaluation is both ways. Either revaluation upward. If you value your asset upward, it's likely to create a deferred tax what liability, or it's likely to create an additional taxable temporary difference, which will then create additional deferred tax what liability. If there's a valuation downward, then it's likely to create a deductible temporary difference, which will then create a deferred tax what asset, right? And I started saying if there is a deferred tax liability, an additional deferred tax liability as a result of revaluation, then we shouldn't charge it to P&L, we should charge it to OCI. If you remember, we charge deferred tax says to P&L. Are you following? But I started saying if there's revaluation and revaluation has caused extra deferred tax liability, then that extra deferred tax liability should not be charged to P&L. We should charge it to what? OCI alongside the revaluation gain. You know, we record revaluation gains in what? OCI. So we record the revaluation gain in OCI, and the deferred tax liability as a result of the revaluation should also go to what? OCI. Should also go to OCI to go and reduce the revaluation gain, right? And it says it is disclosed either in the statement of profit or loss and other comprehensive income, or in a separate statement showing other comprehensive what? Income, right? So that's it with revaluation. It's very simple. We said if there's revaluation gain, it's the gain, the revaluation gain will create an additional deferred tax liability, and that additional deferred tax liability should not be taken to P&L, but should be recorded in other comprehensive income to go and reduce the revaluation gain. Very good. So that's it. We have an example here. Okay. In the next video, we'll solve this example and then we'll look at the disclosures, and then we are done. Then we'll go to the question and answer session. Right. So in the next video, we are going to solve this question. It's on revaluation. So we'll solve it and then find out how we treat the deferred tax asset or liability as a result of revaluation. Look at how we treat it, and then we'll look at the disclosures, and we'll draw the curtains on IES stuff. But we'll look at the question and answer session where we solve more questions, right? So I'll see you in the final part.